We're getting close to the end of the year, so in this episode, I'm going to give you 9 ways to improve your finances, reduce your tax bill, and set yourself up for success going into 2025 and beyond that. Whether you're retired, still working, or just getting started on your financial journey, there's going to be something for you in this episode. And stick around for number 3, because this one is brand new for 2024. We've never had to plan for this before, so stick around to see if that one might apply to you. So with that introduction, let's get started right here on the Canadian Money Roadmap podcast. If you're new to the channel, hi, I'm Evan. I'm a certified financial planner. I'm based out of Saskatoon, but I work with clients in BC, Alberta, Saskatchewan, Manitoba, and Ontario. So today's topic is going to come from real world experience working with real people and some of the recommendations that I've been giving over the last few weeks. Okay, let's get into number 1. The first thing that I'm going to talk about here is opening a first home savings account, or FHSA. Why does this matter? So even if you're not ready to contribute to one, simply opening an FHSA allows you to get the contribution room. If you don't have one open, you can't use the room for this year, obviously, but then you can't carry forward the unused room into next year and beyond as well. So if you are someone who doesn't currently own a house, if you're a renter, if your kids are at least over 18, I'd recommend that you open a first home savings account. This is a great place to start, but it's also a great place if you're planning on being a lifelong renter, because when you make contributions into it, you get a deduction, meaning it reduces your income, and so you pay less tax. And then when you take the money out to buy your first home or to buy a home, you don't have to pay any tax on the withdrawals on the way out. So it's kind of like an RRSP on the way in and a TFSA on the way out. Even if you plan to be a lifelong renter, the cool thing about the FHSA is that it doesn't use up your RSP room. So perhaps you've maxed out your RSP and you're planning to be a lifelong renter, and FHSA would still be a good option for you because you still get the benefits of an RSP without needing additional RSP room. So the annual contribution limit is $8,000. So if you wanted to use that here in 2024, obviously you have to open it. But if you plan on using it sometime in 2025, if you open it now in 2024, you get the $8,000 for this year. Then once the new year rolls over in January, you get another $8,000 of room. So even if you don't add any money to it this year, as long as you open it, then you can do $16,000 of contributions next year to get started for saving for your house. Parents, this is a great way to help your kids because buying a house is just so expensive, especially in the major centers here in Canada, Vancouver and Toronto in particular. And so if you're hoping to give your kids a leg up, I'd encourage you to help them set up a first home savings account and get some money invested there. Okay, number 2 is tax loss harvesting. This is the idea of selling investments at a loss in your non-registered account. So this is not applicable if you're using an RSP or a TFSA or a LIRA, so that's old pension money. This is only applicable for non-registered investments. So when you have non-registered investments, capital gains tax is applicable to you. But if you have investments that you've sold at a loss, you can use those losses to offset gains in the current year. You can carry them back. So if you want to refile your taxes, if you had gains in the previous 3 years, you can do that, or you can carry them forward indefinitely. The interesting thing with capital losses is that even if you pass away, in the year that you pass away, capital losses can be used to actually offset regular income, but only in the year that you pass. So beyond that, they're only used to offset capital gains, but you can carry them forward to a year into the future where you might have some of those gains. There are some really specific rules that I'm not going to get into for the sake of this episode. If you are planning to do tax loss harvesting, please work with an accountant or someone that knows your tax situation and can provide licensed advice. This is not brother-in-law territory here. So if there's a professional that you work with for your taxes and financial planning, this is where I would engage them to see if tax loss harvesting might be appropriate for your situation. Okay, now number 3 is the other side of that coin, which is tax gain harvesting. So this is kind of unusual, but this one is new for 2024. Why? Well, there's some new rules that have been proposed. They aren't law yet, but if the current government is able to pass the new capital gains taxation rules, they're able to backdate it to when they originally suggested that it would be relevant as of. So even though it's not law yet, I wouldn't bank on this one just slipping through the cracks. So tax gain harvesting is that idea that now that we have kind of a 2-tiered system for capital gains tax, the amounts under $250,000 and the amounts over $250,000, it might be prudent to start taking a look at your own situation to see if triggering some capital gains, perhaps annually, under that $250,000 threshold might be reasonable to consider. If tax loss harvesting is where you want to employ a professional to help you make a good decision on this, tax gain harvesting is even more so this way because there's a lot of nuance that goes in here. But since gains below $250,000, you pay taxes on half of the gain, whereas any amounts over $250,000, you pay tax on 2/3 of the gain. This is potentially a really big deal, especially for those who are invested in real estate and perhaps selling real estate investment properties. Say you had a cabin, you can't pick and choose little bits of it to sell like you can with a stock portfolio or mutual funds or ETFs, right? So if you have large capital gains transactions, maybe even selling a business, rental properties, these kind of things you can't like pick away at. They're going to be big lump sum transactions. But if you have those things that are perhaps coming in the future, plus a non-registered portfolio, again, this is only for non-registered investments, not RSPs, TFSAs, LIRAs, nothing like that. But if you have a large non-registered investment portfolio that's been growing, we've had a couple of great years here in the stock market, this might be a time to consider whether it makes sense to start triggering some of those gains. So a little bit of proactive planning here with your accountant, with your financial planner might be a good idea to consider. It is not going to be appropriate for every single person. So again, this is not blanket advice, but just something to be aware of if you are someone that has a large portfolio of non-registered investments. Before we go on to the next one here, if this episode has been helpful so far, please click that like button or maybe consider texting this episode to a friend. That really helps out the channel, reach more people, and help people set themselves up financially for next year. Thanks so much. Okay, number 4, timing your TFSA redemptions. This one's kind of interesting. So the way that a TFSA works is that you have a set amount of contribution room that you can add money into the plan. Then from there, it can grow, hopefully, but it can be invested and it can grow. And then when you make a redemption from the plan, you can actually recontribute money back into it based on how much you take out. So the cool thing is here is that say you had $100,000 and you need to take $50,000 out of it. When you take the $50,000 out, then the following calendar year, you can put $50,000 back in if you have the capacity to do so. The reason you might want to consider doing something here close to the end of the year is that we're close to that rollover period. So if you're going to make a withdrawal, you'll get that contribution room back very, very soon in January of next year. Whereas if you made a redemption in January, then you have to wait a whole 12 months before you can make a recontribution to the plan. I don't know what your financial situation is, but if you're thinking of making a TFSA redemption sometime early on in 2025, I would say consider doing it closer to the end of 2024 to make sure you get that contribution room back as soon as possible. Number 5 is charitable giving. So this one does have a year-end deadline. So if you make a charitable gift to a registered Canadian charity, you can get a receipt for that, which allows you to create a tax credit when you file your taxes next year. A tax credit reduces your taxes owing. It doesn't reduce your income. A credit shows up at the bottom. So credits just eliminate taxes owing, and giving to charity can create tax credits for you. Here's one that you might want to consider now as part of your charitable giving strategy. So if you are someone that has that non-registered investment portfolio that has a lot of what we call capital appreciation, so things have increased in value. If you haven't sold them yet, that's what we call unrealized gains. Realizing it means that you sell it and then you have to pay tax and deal with the consequences of that. But if you have unrealized gains in stocks, mutual funds, ETFs, whatever, you can actually give those to charity and you can get rid of the capital gains associated with that if you do it appropriately, right? So a lot of people end up just cutting a check at the end of the year. They might even sell some of their investments and then write a check. But there's a lot of different programs that are available to help facilitate this type of transaction where you can give your securities. We call it in kind. So it's an in-kind donation. And so the charity can then receive it and you get a credit for the full amount, and the capital gain that was associated with it is wiped clear. So it's a great way to save taxes by getting the credit, but also eliminating the capital gains associated with the securities that you gave. Again, giving securities in kind can be relatively complicated. And so if you work with a financial planner or an investment advisor, I'd recommend talking to them to make sure that everything is done appropriately to make sure that you are able to save those taxes and get your credits. Number 6, you could consider doing an RRSP contribution. The deadline for this one is a little bit unique. It is not right at the end of the year. You do have the first 60 days of next year to do it, but by the end of the year, you kind of have an idea of how much income you've earned already. And so now you can start to make a decision on whether making an RSP contribution makes sense for you. Just as a refresher, when you make an RSP contribution, it reduces your taxable income. So that means you pay taxes on a smaller income amount, thus lowering your tax bill. And so many times you can get a refund associated with that if you have traditional employment income. If you're self-employed, that just means your tax bill is just going to be a little bit lower. But RRSP contributions can be a great way to reduce your tax bill and maximize your retirement savings. You don't need to do it now. This isn't the deadline here coming into the end of the year, but by planning for it in advance, it helps minimize this stress around the end of February when the actual deadline is, and you can just get it off your plate and deal with it right now. Number 7 is RESP contributions, a registered education savings plan. So if you have kids or grandkids and you have been contributing to an RESP, by making a contribution this year, you'd be able to get some grant money for them. So the government will match up to $500 per year in grants, and they match 20% of your contributions up to that amount. The final year to receive grants is the year that the child turns 17. So it's not on their 17th birthday, it's in the calendar year that they turn 17. There's a few little weird rules that you have to get the contributions in that 17th year. You have to have made some contributions in the previous year and so on and so forth. It's a little bit more complicated than what I want to get into here, but essentially, if your children are nearing the age of 17 and you haven't received maximum grants in prior years, you can make top-up contributions. You can do this at any time. You don't have to wait till they're 17. But the reason why a year-end kind of matters here is that you get contribution room based on the year that they were born, not their birth date. Okay, so someone that was born January 10th of this year, so new baby in January, and we're in the middle of November here. So January 10th or November 10th, each of them has the same amount of contribution room available that can be matched with grants. And then as soon as the year flips over, this kids get the same amount of contribution room right away again in January. Okay, so you get the contribution room based on the year that they were born. But if you haven't used the maximum contributions yet, you can catch up from previous years that you missed up to 2 years at a time. So to get the maximum grant, you have to contribute $2,500. You can do more than that, but it just won't be matched with grants. But to maximize the grant money, you can contribute $2,500 for the current year, plus you can do an additional year that you might have missed in the past. So say your child is 5 and you haven't set up an RESP yet, you could set one up now, put in $2,500 for 2024, and you could get another year's worth of contributions from a previous year. So you could put in $5,000 for this child and get $1,000 of grant based on this year's room and one previous catch-up year. So the reason that the year end kind of matters here is that the catch-up room then resets essentially, right? So if you want to start taking advantage of it, get it going now, and then you can use your catch-up room from any previous years and this year, and then you get another year coming in January. So you can really accelerate this if this is part of your financial planning. Number 8 is a RRIF conversion. So this is the second life of an RRSP, pardon me. So this is a RRIF is a registered retirement income fund. This is how I always describe these accounts. So an RRSP is just a bucket. It's not an investment in itself. It is a bucket that can hold investments, but at some point you have to take money out of it, and this is the time. Okay, so when you turn 71, that is the year. So it's the year in which you turn 71, not on your 71st birthday. In the year that you turn 71, you have to convert your RRSP bucket into a RRIF bucket, which is a bucket with a hole in it. So it has a leak in it, meaning you have to take some money out of it every single year. So if you are 71 in 2024, you have to convert your RRSP accounts and your LIRA accounts to RIFs and LIFs. There's a few more complicated ones in there too, but if you have any of these accounts, they have to be converted to income producing accounts by the end of this year. Okay, so when you have this leaky bucket, you have a minimum amount that you have to take out of it every single year. We call that your minimum. And the minimum is based on your age. So there's a percentage amount that you have to withdraw based on your age. And as you get older, that percentage increases every year. But it's also based on your account balance as of January 1st. So when you convert it to a RIF here this year, when the calendar year turns over, your financial institution will then know how much you've contributed or how much is in the plan, and what percentage needs to be taken out. And from there, you can decide what you want to do with it. You can spread that out over the year. You can take it as a lump sum. You can take it at any point. But that minimum amount has to come out sometime in the calendar year of which you turn 72. So if you really don't want the money and you want it to stay invested for as long as possible, you can still convert your RSP to a RIF in the year you turn 71 and wait till the end of the year that you turn 72 to take out your annual minimum if you really want to get cute with it and leave your money invested as long as possible. I don't necessarily recommend that, but some people just don't need the money and they don't really care and they just would rather keep it invested. That's an option that you can do that, but the money has to start coming out next year. The last one that I'll loop in here is probably a little bit different. I haven't talked about this one, I don't know if ever, on the podcast or the YouTube channel. It's an RDSP. So this is a registered disability savings plan. And this one is very, very unique. So if you are someone who qualifies for the disability tax credit or DTC, then you are eligible to open a registered disability savings plan. I'm not going to get into the details of that necessarily, but if you are someone who qualifies to receive this, and many, many, many people do that have not applied for it, I'd encourage you to maybe look this up to see what types of conditions could be eligible to receive the disability tax credit. You have to work with your doctor on this. They have to sign off on some paperwork. For many people, it's a bit of a no-brainer. And then you become eligible for this RDSP. The benefit of an RDSP is that there's piles of grant money available for people who qualify for it. But the last year that you can receive grant money in the account is the year that you turn 49. Okay, I'm not going to get into the specifics and the details of this. Maybe that should be a separate episode altogether because these things are pretty complicated. But if you qualify for the disability tax credit, make sure you have a registered disability savings plan open because you can get all this grant money. You can get up to $3,500 a year, and some portions of your grant can be matched up to 300%, some 200%. All depends on your income and a few other things, but there is free money out there if you qualify for this, okay? So if you qualify to have an RDSP, I would highly recommend that you make contributions to maximize those as soon as you can. Again, age 49 is the last year that you have to make contributions for this. It's not like an RRSP where you have the first 60 days of the next year to make the contribution. You don't get a deduction for it in the same way, so they don't have that timeline. But just making sure that you maximize those grants annually would be a great thing to do, especially for folks that have disabilities where it's harder for them to save and perhaps earn income. So that was a bit of a whirlwind here, but I'm just going to summarize again. Number one, open a first home savings account to either contribute this year or carry forward room for a future year. 2, tax loss harvesting. So if you have anything that has decreased in value and you're currently in a loss position, consider working with your tax professional to see if tax loss harvesting might be appropriate for your situation. On the other end of that is tax gain harvesting to see if triggering some capital gains under the $250,000 threshold might be prudent for your long-term planning. Number 4, timing TFSA redemptions for the end of this year instead of early of 2025 so you can get your contribution room back. Number 5 is charitable giving so that you can get tax receipts and also obviously help the charities that are important to you in your community. Doing a gift of securities in kind will allow you to get rid of capital gains associated with those investments. And doing that sooner than later would be a good idea. I'm thinking very early on in December, just so that your institutions have enough time to process these transactions, as it often takes a little bit more time than just a sell or a new investment purchase, things like that. Number 6 would be an RSP contribution. This isn't the firm deadline here at the end of the year, but it might be a good time to start planning for that. RESP contributions. Number 8 is a RRIF conversion. RIF conversion is again going from RSP to a RIF now that you've turned 71, or this is the year that you turn 71 and you have to start taking some money out. And number 9 is an RDSP contribution if you qualify for the disability tax credit and you have a registered disability savings plan. So some of these are maybe familiar items to you and you've done them before, but hopefully there's something new there that maybe triggered something for you to dig a little bit deeper into your financial situation to see if perhaps you can save a little bit of tax, get a little bit more grant money, and set yourself up better for the future. Thanks so much for watching this episode here on YouTube or listening on the podcast player of your choice. I really appreciate you all being here, and I look forward to seeing you on another episode of the Canadian Money Roadmap sometime soon. Thanks.